Good day. This is Milton Flanagan with Flanagan Financial Services. Dividends aren't guaranteed, are they? If we learned anything during 2020's pandemic with companies that paid dividends, was that dividends are not guaranteed. During the 2020 pandemic, a number of companies either cut their dividend or eliminated the dividend to retain capital. Possibly now, one of the largest companies has just informed their shareholders that they are going to cut their dividend by 50%. AT&T announced earlier this week, in an effort to improve the company's financial position and possibly increase the stock price, that they were going to cut their dividend by 50%. If you were to ask someone that's an AT&T shareholder if they bought AT&T for the price appreciation of the stock or for the quarterly dividend, I'm sure many of them would say the dividend. Just a reminder, dividends are not guaranteed. Many people may utilize dividends in retirement to supplement their income. Let's remember that in order for a dividend to be paid by a company, it needs the following. The board of directors has to declare the dividend. The company has to have the cash on hand to pay the dividend, and they need to decide if this is a strategic benefit or potentially just a one-time off event. Many individuals have a diversified portfolio, which might consist of stocks, bonds, mutual funds, CDs, or other alternatives, assets that might generate income. As you approach retirement, maybe the question should be, how much income will these assets generate for me? More importantly, if you have a diversified portfolio, maybe the better question is, do I have a diversified, sustainable income strategy from these assets? How much of your money is invested in instruments that could potentially provide protected lifetime income? All, some, none might be answers. If you aren't sure, I would suggest you know that the answer is before you decide to hang up the cleats. Otherwise, you could possibly draw too much money too soon and run out of money, be impacted by sequence of return risk and run out of money even sooner, or just swing it and hope for the best. Potentially, and personally, I would not recommend any of these options for it. You see, before you retire, you are in the I think mode. I think this money will generate enough income. I think it will last a lifetime. I think it won't be affected by the market and my income will be affected. I think Social Security won't be reduced, and possibly more I thinks. Instead, you need to be in the I know mode. I know exactly how much Social Security will provide. I know exactly what my pension income will be. I know how much income the money that I saved will provide for me. I know this money will last my lifetime. You see, you move to the I know stage, not the I think stage. You see, you need to know if there's enough fuel in the airplane before you leave the airport, not realize there's not enough in it to reach your destination once you're in the air. Would you get on an airplane if the pilot said, I think we have enough money to get to our destination? Wouldn't you want to know if there's enough fuel in there for it? With low interest rates on bonds, CDs, and other cash-related assets at record lows, instead of having $100,000 maybe in these instruments, you might need $200,000, $300,000, $400,000, $100,000 or more to earn the income that you may have earned on $100,000 previously when interest rates were paid at a higher rate. Since dividends aren't guaranteed, and some of these instruments' income isn't guaranteed, are you sure that your income will not be affected should a company decide to reduce or eliminate its dividends? Do you know or think you know what your income will be each year? As an example, if you're married and own your own home, then there are two mandatory expenses in retirement. Health insurance, Medicare is mandatory. If you have a traditional Medicare, then a married couple could spend just on premiums between Part B, the supplement, Part D, between $5,000 and $10,000 per year. Should you own your own home, you could spend anywhere from $1,500 to $15,000 or more on property taxes. That could be $10,000 to $25,000 per year before you even eat breakfast January 1st. Do you have money set aside to cover at least these required expenses for possibly 20, 25, 30 years? If you'd like to learn more about protecting your retirement income and knowing how much income you could receive in retirement, then give me a call, Milton Flanagan, at 630-235-5273, or you can email me at mflanagan, that's F as in Frank, Lanagan, at FlanaganFinancialServices.net, and we can schedule a time to talk and possibly develop a retirement income strategy that possibly answers some of these retirement income questions. Remember, once you hang up the cleats, you may not get a chance to do this over again. This is Milton Flanagan with Flanagan Financial Services, and thank you and have a great day.